joining me. As you can see on the screen, we had Nikki who was going to participate in this webinar as well, but unfortunately she lost her voice. So you get to listen to me for the next 20 minutes. So I will do my best to try to keep you entertained. So the first thing I want to talk about is why do we need to focus on exit planning and why do we need to have a written plan? And some of these things we're going to recap from the previous 2 webinars that we went through, but I think it's important that you just understand before we dive into the sale to an insider. So most business owners plan to exit their businesses within the next 10 years. And 75% actually say they would exit today if they were guaranteed financial security. 83% have not created a plan. And I found this quote that I thought was very interesting that I just wanted to share is, businesses get bought, not sold. And really what that means is, if you plan well enough ahead of time, you're not going to actually sell your business, but you're going to be very enticing to a buyer. And right now, in the M&A world, we're seeing a lot of companies that are being approached by larger companies, strategic buyers, looking to buy their businesses. So I thought this quote really fit really well into what's going on right now in the market. So how long before they want to get out? As I mentioned before, most of them want to leave their businesses in the next 10 years. And it really takes 5 to 10 years to create a plan. You know, as you can see on this little diagram here, we have 33% who say 0 to 3 years. We have about 24% in 3 to 5. And then 10% or more is a smaller portion. And then you have a really small portion who say never, which I believe everybody would exit their business if the time and the price was right. So why don't business owners have a written plan? Well, these are just some reasons why we hear. They're not ready. They have more pressing issues, insufficient value, and some of these things are things we've talked about in our previous 2 webinars, so hopefully you attended those. If you haven't, please feel free to call us and we can go through those with you. I'm too busy, or I don't feel a sense of urgency. And one thing that I want to point out here is sometimes optimism can be an obstacle for people, because sometimes people think that their company is worth a certain amount. They really have everything under control. There's no reason they would be able to get top dollar for it. So sometimes that optimism can actually be an obstacle for business owners. So when we talk about exit planning, we really talk about 3 main objectives. The objective is to sell your business when you want, for the money you need, and to the person you choose. So we're going to really focus on to the person you choose today. And when you look at the person you choose, you can be looking at a third-party sale or a sale to an insider. And we're going to focus today on a sale to an insider. So selling your business to the person you choose. When we look at an insider, we actually have a couple of different options here. We can sell to a key employee or a group of employees, a management team. We can sell stock to a business active child or gift stock. We're going to talk about that. Or we can sell to an ESOP, an employee stock option plan. So here's a little bit of information on the market and where we really see those sales right now. So as you can see, in 2016, third-party sales were by far almost the highest out of any other type of sale. You can see almost 60%. But right behind that is sale to an employee. And that's because if you really take the time and you plan, this can be the less riskiest of all the options, and we're going to kind of explain why in a few minutes. So transfer to an insider. As I mentioned before, that can be a family member, a co-owner, or a key employee. And I just want to point out that a family member, it can be a family member who's active in the business, is probably the best bet. It can be multiple family members, and there's different ways that we can transition to family members. So what are some of the benefits? Well, a benefit to an inside sale is really that you can maintain control of the company. You can choose who the successor is, and you can also achieve your value-based goals. And what that means is most people who sell their business to an insider, they're not as concerned with the price that they get for the business is they are concerned for these value-based goals. And that's really maintaining the legacy and the culture of the company. I've met with quite a few people recently who have said, I don't really need a certain amount of money, but what I need is I need to make sure that my employees keep their jobs. I need to make sure that the culture that we've created over the years stays within the company. And that's why selling to an insider or a management team or a child, these can all achieve those value-based goals. And in many cases, it can also achieve your financial goals as well. So what are some of the challenges to selling to an insider? Well, I think the biggest challenge can be that typically there's no money up front. So typically, an insider isn't going to have a down payment that they can give you. And I'm going to show you some examples as we get further into the presentation of how the money can actually be received. And you'll see that in the long run, most of the time you're going to get more money out of it, but it takes a lot more time. There can be a little bit of loss of control as you turn the company over to your management team or your child. There's going to be a little bit of that loss of control. However, there is a way that you can maintain that control by maintaining the voting stock. And what that means is even if you sell 99% of the company, you can hold 1%, which is 100% of the voting stock of the company. Therefore, you do keep control of the company. And I always recommend that until whatever payment is made is completely paid off. So if there is seller financing, which there always is in an insider sale, you don't lose that control until the last payment's made. One of the other challenges, sometimes a business can't run without me, we've heard. And again, if you have a good management team in place, and we've talked about this in some of our previous webinars, having that management team is extremely important, and I'm going to give you an example later on what that would look like selling to a management team over time. And this actually, although it's a challenge, it can actually be a benefit as well, and I'm going to explain that. And sometimes the business value isn't high enough. And really when we talk about business value, there's several different drivers that determine what the business value is, and there are ways that we can increase those value drivers, which again, we had discussed in a previous webinar, but we'd love to talk to you about that if you have more questions on that. So the first thing I want to focus on very, very briefly is an ESOP. And an ESOP is an employee stock option plan. And sometimes an ESOP can be good for a company if, again, the owner wants to maintain that culture of the company, that legacy, and if they have a really good management team in place. And the more employees you have in an ESOP, the better. And I'm not going to get into a lot of details on an ESOP because they can be a little bit complicated. But some of the biggest benefits of an ESOP is that there's a very, very large tax advantage to it, and that people aren't paying the tax until the money is taken out of the ESOP, so until they're actually retiring. So the money is put in an ESOP, and then it's not taxed until it's taken out of the ESOP. There can be more cash sooner to the owner. However, this can also be, it's a benefit, but it can also be a disadvantage because oftentimes the owner has to guarantee the loan that's taken out to pay the owner off. And this can really help motivate your workforce because essentially your employees are owning the company. So they have a lot more skin in the game and they're a lot more interested in seeing the company increase in value because that's going to mean more money for them when they retire from the company. So some of the challenges to an ESOP can certainly be the complexity that I had just mentioned a few minutes ago. They can be costly. ESOPs have to be valued each year. And any additional stock sold to an ESOP, every time that's done, the company has to be valued as well. So it can get quite costly. I have heard that the minimum cost sometimes to set up an ESOP can be around $40,000. I think it can be done possibly a little less than that, but it depends how complex your company is. You know, the sales price to an ESOP, that can be challenging too, again, because that's based on a formal valuation of your company, and the employee perception. There are some companies that the employees don't want that responsibility of being an owner of the company. So, sale to an employee. This is where I wanted to give you some examples. So, what I'm going to do is I'm going to walk through an example here of what a real life situation was that we had here for somebody selling to one of their employees. So we're going to use a sales price of $1.395 million. And the way we can structure this is we can be very creative with these sales to employees. So we can sell the first 40% of the company over 4 years, and that can be 100% seller financed. So what that means is the employee is going to pay the seller that 40% over 4 years through distributions in the company. So then what they would do is once those 4 years are paid, they would the owner would sell an additional 40% over another 4 years, all seller financed, and then sell the final 20%, in a lump sum payment at the end. So as I said, these are all paid through company distribution, so there's no cash out of the pocket for the employee buyer. The owner is going to maintain 100% of that voting stock until this final 20% is paid off. And the total payments received over the course of these 8 years actually equate to, in this example, $3.79 million versus $1.395 million if they were to sell to a third party. And I know you're wondering, how can that be? That doesn't make sense. Well, the reason for this is because, A, in the first 4 years, the owner is going to continue on in their same capacity and they're going to receive their same salary they were receiving. So in this situation, the owner was receiving a salary of $150,000 a year. They're going to continue to receive that for 4 years as they work very closely with that buyer or management team to make sure that the company is transitioning properly, introducing them to customers, vendors, really being on site and being a mentor for that management team or that buyer. They're also receiving 60% of the distributions. So 40% of distributions are used to pay the seller. So the seller is receiving 60% of the distributions, and this is assuming that this particular company is an S corporation. Now let's jump to the next 4 years. So the next 4 years in this situation, the seller backed off substantially. They were only on site 10 to 15 hours a week to, again, helping ensure that that transition moved effectively. So they were receiving a small salary, and now they're still receiving 20% distributions for the company. So in the first 4 years, they got 60%. Now they're receiving 20% of the total distributions of the company. So they're continuing to receive money, plus they're receiving their loan payments. So they're getting the second 40% of loan payments, they're getting a small salary, and they're getting a small distribution. And then at the end, they get a 20% lump sum payment. So over time, they're going to see a lot more cash, but as you can see, this is about an 8-year transition, which really ensures that the company continues to move forward and that the owner is transitioning the company very slowly. So there's a lot less risk in this situation, but there's a lot more money involved. And this actual situation does not take into consideration any income tax, but it also does not take into consideration any investments on money received. So if the owner invested that money, they would actually receive more. So here's another example of how you could structure a sale to an employee. Same sales price, $1.395 million. Now let's assume that they sell 100% of the company. They're selling it with an SBA loan, which carries a 10% down payment. There's a 75% SBA loan, and 15% is seller financed. Now, the SBA does require seller financing, especially with this low down payment. Many times the payments are deferred for the first 3 years as well. So there's not as much cash coming to the owner in an annuity, but they do get this down payment and they get the 75% of the SBA loan. So just the 15% they're going to have to wait a little bit on. But in this situation, because they are no longer receiving a wage, they're no longer receiving any distributions, they're going to see $1.435 million on a $1.395 million sale. And again, this is without regard to income tax. So I think in these two examples, you can see the difference in the cash, but there's also a substantial time investment by the seller. So another option we have here is to sell an interest to a child. So in this particular situation, let's assume we have a company with a value of $3.25 million, and we're going to sell 20% of that to our child. And this is an active child. So out of that 20%, the capital gains tax on that is going to be about $130,000. We're going to assume that there's a promissory note that carries 5% interest, and that 20% of the S-Corp distributions, or the $200,000, are being paid to make these loan payments, which still leaves $120,000 per year as cash flow available for this note payment. Well, in this situation, as you can see, this is going to take 76 months to pay. So still a time commitment to get paid, but again, the owner can stay on. They can make sure that the company is transitioned properly. They can make sure that all of the customers and the vendors are working well with the active child. So again, time commitment, but a little bit less risk. Another option is to gift stock. So they could give $15,000 a year under the annual exclusion. So dad can give the daughter and son-in-law $30,000 a year. But again, assuming the value is stable, the $650,000 or the 20% interest is going to take 21 years to complete. So I don't think this is probably much of an option for most business owners, but it can be done. Then there's also the one-time annual lifetime exclusion, which you have of $11.2 million if they gifted the entire amount. There could be some tax consequences with that, but we're not going to go into that detail at this time. So another option would be the bonus the stock. So you could take 20% interest and value it at $650. So the daughter's stock on that bonus, $260. So now here the company can take the $650,000 deduction because it's a bonus. So the company gets the deduction, the daughter gets the stock. So as you can see, cash bonus from the company, $430,000. Tax on that cash bonus is going to be about $172,000, which is the net cash to the daughter, $258,000, which is going to be used to pay for that stock. So what we do here is we use BEI's 7-step process in our exit planning. And so we talked about one is really identifying the exit objectives of the company, quantifying the business and personal financial resources. This is a very, very important piece. This is how much do you need to exit the company, because this could really determine which type of sale you have. Is it a third party, a sale to an insider? You know, this is a very important step that we see many people miss. Then we want to talk about maximizing and protecting the business value. When we talk about the value of the company, there's really 3 objectives. We want to preserve the value, protect the value, and promote the value. So preserve the value is really minimizing the tax. Protecting the value is really minimizing the risk. And then promoting the value is really maximizing the value. So that step is also very important. And then we want to look at how do we want to sell that? Is that going to be to a third party? Are we going to transfer to an insider? What is our idea on how we want to exit the company? And then we want to look at the business continuity. And this is also a step that's very important. We want to make sure that if there's an unexpected death or illness to the business owner, can the company continue? So this is really talking about having things in place like life insurance, documenting processes, so someone can come in and take over. Who is really going to take over the business in the event something like that happens? And then the step 7 is really the personal wealth and the estate planning. We want to make sure that before you exit the company that you have an estate plan in place. Again, you know how much you need. How are you going to be investing that money? We want to make sure that you can continue the lifestyle that you need when you leave the business in a lifestyle that you're comfortable with. So really, we have an assessment that we can take, that we can give people for exit planning, and really what that will do is that will really look at all of these things that we talked about, and that will really show you where you are on the spectrum. And those are areas that then we can focus on. You know, many times it might be something like improving the value or really determining how much you need from the company. So this assessment we can give you can help us determine that. So with that, I think I'm about out of time, and I'll open it up to any questions we might have.
If anyone has questions, feel free to enter them into the chat section on the webinar, and Nancy can answer them for you. And of course, we always have availability to talk with Nancy or Nikki at another time, so you can feel free to reach out to them as well. I did want to share that we do have 3 e-books on exit planning that are available on our website. You can just go to svaaccountants.com and look for Transition Exit Planning. There's a book on exit paths for business owners, and then there's a specific one on transfer of a family business and transferring to company or key employees. So all 3 are good resources for you as well. It doesn't appear that we have any questions. So with that, I'd like to thank Nancy for the seminar today. And as always, please reach out to SVA if you have any questions. Thank you.
Thank you.